We'll be going over IRS Form 8396, Mortgage Interest Credit. So certain qualified taxpayers may take a tax credit for mortgage interest that they paid on a mortgage with regard to their primary residence during a given tax year. However, to be a qualified taxpayer, you must hold a qualified mortgage credit certificate issued by either a state or a local government unit or agency. Generally speaking, these state and local programs administered by agencies are focused on helping lower income taxpayers become homeowners or maintain their homes. So this is kind of a tax incentive for lower income taxpayers. In general, federal programs such as Homestead Staff Exemption Certificates, certificates issued by the Federal Housing Administration, the Department of Veterans Affairs, and the Farmers Home Administration do not qualify for this tax credit. The certificate also must be related to your primary home, and that home must be located in the jurisdiction of the unit that issued the certificate. So if you don't know whether you qualify for this tax credit, you should contact the applicable state or local government agency that administers the mortgage credit certificates in your area. If you're qualified through them, then you may be eligible to take this tax credit. You can also take this tax credit even if you refinance your home, if you meet certain criteria as outlined on the back of this tax form under refinanced mortgage. We won't go through all of these details. That's just a frequently asked question. The answer is yes, with certain conditions if you adhere to those requirements. If you buy a home using a mortgage credit certificate, then turn around and sell it within a 9-year period after the purchase of your home, you may have to repay some of the tax credit. In order to be able to calculate that, you would be required to complete IRS Form 8828, recapture of federal mortgage subsidy, and that will help you calculate how much tax you may owe on any credits that you've taken over the course of your mortgage. So let's start with just kind of going over the form. There's a section at the top with some key information that you'll need to have to calculate this this credit, as well as two parts. Part one regards certain current year mortgage interest credit. By the time you go through part one, you will know what the amount of your credit is that you can take during the current tax year. And then in part two, if there's any extra credit that you can't take in the current year, then you use part two to calculate what you carry forward and specifically what is allocated for previous tax years. So to kind of help understand part two, we'll go through a little bit more about how those credit carry forwards work when we get to part two. So for part one, let's kind of focus on part one, and we'll start with line one. Again, the information that we put into this form may or may not be realistic when compared to your particular situation. This is just so that you can kind of understand the mechanics of the form calculations. Before we start with part one, we are going to go through the information at the top of the tax form for our hero, John Smith. So notice that this address specifies that you should only enter the address to which the mortgage certificate relates. If this happens to be the exact same address as your primary residence, which is already on your tax return, you don't need to enter any information in this field. You'll enter the name of the issuer of your credit certificate. It's probably going to be your local or state agency. You're going to have to enter your certificate number. So this is assigned by your agency. So the numbering convention is probably different from agency to agency. And then the issue date. So we'll just assume that this is for 2019, that this was issued. That way we can use some of the lines that relate to the previous tax years when we get to those sections. Now, before you begin part one, you should probably have already gone through your tax return to the point where you're able to claim, or you know how much you may be claiming for credit for the elderly or disabled. That's on Schedule R, the alternative motor vehicle credit, and qualified plug-in electric motor vehicle credits. So just have that information handy and as you work through this. So in part one, we're going to complete the interest paid on the certified indebtedness amount. So this would be the amount that's located on your Form 1098 of your tax return, or of the mortgage interest statement that you should receive from your lending institution. This will be the number usually that's in box 1 of your Form 1098. If the amount on your credit certificate is less than your total mortgage, then you must allocate the interest to determine the amount that relates to the loan that's covered by your MCC versus the remainder of the loan. For example, if you had a $100,000 total mortgage, but it was actually 2 different loans, and your MCC had $80,000, but you took out a line of credit or a home equity line for $20,000, then you would only enter the amount of interest that you paid under the MCC. And if you had an interest in this home with someone else other than your married partner under a joint tax return, then you would only enter your prorated share. So if someone is kind of paying this loan in conjunction with their parents, starting them on as a first-time home buyer, you would only enter the amount that you personally paid. For line 2, you're going to enter the credit certificate rate that's shown on your credit certificate. This is not your mortgage rate, and this is normally going to be a number between 10% and 50%. Actually, the form instructions specifically state do not enter a number less than 10%, do not enter a number greater than 50%. So we'll just say that this is 20%. Now on line 3, you will need to decide whether or not your credit rate is 20% or less, or if it's greater than 20%. If it's 20% or less, you simply multiply line 1 by line 2, and in this example, we would come up with $1,000. So if, for example, this is 30%, the form instructions state you can still do this calculation as long as you don't enter an amount greater than $2,000. $2,000 is the maximum amount of credit that you can apply for the given tax year based on your mortgage interest paid. If you refinance your mortgage, you should see the form instructions. That's a little bit more, I guess, complex than this video, than we can cover in this video. Then you should basically follow the guidance under the refinance mortgage section of this page. And finally, if you paid interest in conjunction with someone else other than your married partner, then you need to prorate the credit amount. If it's limited by the $2,000 limitation, you'll need to allocate how much each partner can take. So if you have a total of $100,000, but you and your partner each paid 50% of the interest, 50% of the mortgage, and for some reason that ends up being $2,000, then you would have to split that so that you're taking $1,000 and your partner is able to take $1,000. And in no circumstances can the total amount of this exceed $2,000 for everyone involved. So now we get to line 4, but any amount that's in line 3, if you're claiming the itemized deductions on Schedule A, you'll need to reduce your deduction for home mortgage interest. You can take a deduction for home mortgage interest and claim the mortgage interest credit. However, you can't double dip by claiming an interest credit that you're also claiming as a deduction for the exact same interest. For example, if you pay $5,000 on interest, then if that's what's on your Schedule A, once you get through this calculation and you come up with $1,000, you would have to go back to Schedule A and amend it downwards, so you're only taking $4,000. That way you're not claiming a deduction and a credit for more than the interest that you actually paid. In lines 4 through 6, you'll be entering previous year credit carry forwards. So for the 2022 tax year, you can carry forward credits from the previous 3 tax years. So that would be 2019, 2020, and 2021. And they appear on different lines based on your previous year filings. So line 16 would match up with this for your 2019 tax return. This would actually, like if you went back to prior year or your 2021 tax return, you would see that this is a 2019 credit carry forward to 2022. So, line 14 of your 2021 8396 would be your 2020 credit carry forward, and then your 2021 credit carry forward to the current tax year in 2022 would be from line 17. So we're just going to put in numbers that assume that all of these were $1,000 carryovers. On line 7, we're going to add all of those credits together, and we come up with $4,000. Now, in line 8, we're going to have to calculate the limitation based on tax liability. The tax liability or limitation based on your tax liability means that you're going to have to reduce or calculate a number on a credit limit worksheet, and then this is going to be the limitation that applies. So $4,000 is the most that you'll be able to take in your mortgage interest credit for the current year. However, you're going to limit this by whatever applies from your credit limit worksheet, which is right here. So you'll enter the amount from your Form 1040, 1040SR, or 1040NR, line 18. We'll just say that this was a total of $5,000. This happens to be your tax liability plus a couple of other line items, specifically alternative minimum tax and another tax that is added onto your 1040. So if you didn't, if you don't know that exactly, that's okay. You'll simply carry the number from line 18 of your tax return. And then these directions here basically ask you to go back to either your Form 1040, your Schedule 3, or IRS Form 5695, which is residential energy credits, so that you can back out those tax credits. So we're going to assume that when we do all of this, that you've already taken $4,000 worth of tax credits from all of these different tax forms. And that means that you're going to have to subtract the $4,000 worth of credits, and you'll enter this on line 8. If this is 0 or less, then you'll enter 0 on line 8, on both line 8 and 9. And then you'll go to part 2, where you calculate, the amount that gets carried forward. So for line 8, we'll just take this $1,000 and we'll put this here. In line 9, you're going to enter the smaller of either 7 or line 8. So that would be the $1,000 here. So this basically represents the amount of the mortgage interest credit that you can take in your current tax year. Again, this is a non-refundable tax credit, which means it can only reduce your total tax bill down to 0. It cannot reduce it below 0. So for example, if your total tax bill was $10,000, then you would be able to put $6,000 up here on line 8, and then you would have to enter the smaller of that. So now in this case, you're using up the entire amount of the tax credit that you're eligible for in the current tax year, and you would not have any mortgage interest credit to carry forward to 2023. So in this scenario, you would simply include this amount on your Schedule 3, line 6G of your Form 1040, and then you would be done. You don't need to calculate any mortgage interest credit carry forward if you don't have any carry forward to calculate. So we're going to go back to our original example of $1,000. And now we're going to complete part 2 as if we do have a credit carry forward and we need to allocate it properly. So in line 10, you're going to add line 3 and line 4. So this is your current year credit plus your credit carry forward from 2019. So this is $2,000. Now you're going to enter the amount from line 7, which is $4,000. You're going to enter the larger of those two, which happens to be the $4,000. In line 13, you're going to subtract line 12 from line 11. And from here, you're going to enter the smaller of line 6 or line 13. This is your 2021 credit carry forward, and that happens to be 0. So that kind of makes sense with the understanding that you've kind of used up that 2021 credit carry forward. So, so now in line 15, you're going to subtract this from your line 13. This is going to be 0. Oh, I apologize. I caught a mistake, and I want to go back and share it with you, just so that you can avoid this mistake. Right here, I mistakenly entered the larger of line 9 or line 10, and this was $4,000. I misread it. I should have entered the larger of line 9 or line 10. So this is going to be $2,000. That reflects the larger of either $1,000 or $2,000. So now when we subtract this from the total credit carry forward, we still have $2,000 that we need to enter, or we need to allocate. So we're going to enter the smaller of either line 6 or line 13, and in this case it's $1,000, not $2,000. This is the 2021 credit carry forward. Now we're going to subtract line 14 from line 13. This gives us $1,000. Now we're going to, for the 2020 credit carry forward, we're going to enter the smaller of either line 5 or line 15. So line 15 is $1,000. Line 5 coincidentally is $1,000. That's just a coincidence. That's not a matter of the calculation. So we'll enter $1,000 here, and then we're going to subtract line 9 from line 3. So this is $1,000. We're going to subtract this from the $1,000 up in line 3. We're going to enter 0. So we basically used $1,000. We are carrying forward $1,000 from 2021 to next tax year. We're carrying forward $1,000 for 2020, and just want to go through this one last time to make sure that we did this calculation correctly. Normally your tax software would do this for you. So we added, okay. It appears that we walked through this correctly. So if you walk through this form, you may have noticed that we're losing we're actually losing $1,000 based on the limitation from our tax liability. So if this were a $2,000, if we were able to use $2,000, then this would look a little bit different. Because we can only carry forward for 3 tax years, we would be able to carry forward the 2021 credit, and then so in this situation, we're losing $1,000 because we could not use the full amount of credit that had been carried forward from previous years. So the 2019 tax credit dropped off. We were still able to carry forward some of the tax credit, even though we used some of it. So in this case, we had $4,000 worth of tax credit available to us. we were able to use $2,000 in the current tax year. Then we carried forward $2,000 to the 2021 tax year. So if we go back to the $1,000 current year example, and then we would use this to enter the smaller of, let's see. So we used $1,000 in 2022. We're carrying forward $1,000 that's allocable to the 2021 tax return. And then for the 2022, we have $1,000 that we can allocate. So in here, we basically use $1,000 in the given tax year. We have up to $4,000, but because we weren't able to use the 2019 credit, then that drops off. So just kind of keep that in mind as you're doing tax planning to claim other credits. You may need to talk with your tax professional to make sure that you're capturing the right amount of credits in a given tax year, particularly if you're participating in certain tax programs. That's all we have for this article. If you enjoy our videos, please subscribe to our YouTube channel. We have written a complete step-by-step tutorial that you can find on our website. Simply go to teachmepersonalfinance.com, type in IRS Form 8396 in the search bar, and this article should appear. And if you like our articles, please subscribe to our newsletter. As always, if you have any questions, comments, or concerns, please send me an email or type a question in the comment section. Thank you very much.